Hi everyone, thank you for watching our presentation today. This is Jishan Lu from Group 2 and our group members are Zexing Hu, Shuxian Zhou, Zipli Yao, and Jie Zheng. Next slide please. Barbara Cheney and risk controller found us to help analyze their budgeted income statement and make recommendations as to whether the company should continue to use the sales agent or not. In today's presentation, we could compare of the break-even sales, estimated sales, and the degree of the operating leverage in three different commission rates. And then we will give suggestions based on the calculation we did above. Next slide, please. So let's begin with the overview of our client, Envy. It's an American multi-level marketing company that sells health, beauty, and home care products. And this company has no sales force on its own. Rather, it relies on independent sales agents to market its products. This agent will get commission from what they sell. Next slide, please.
Okay, so let's get started with the question number 1. Okay, so let's get started with question number 1. Envy company's break-even point in dollar sales for next year's, assuming we need to compare the dates to find out what's the best commissions percentage. First, the agent's commission rates remain unchanged at 15%. So we get the contribution margins is $6.4 million. The total fixed expense is $4.8 million. So we found out the break-even sales $12,000. Next, please. So the agent commission rate is if increasing to 20%, the contribution margin will be decreasing to $5.6 million. The total fixed expense will be $4.8 million. So we get the break-even sales $13,714,285.71. Next slide, please. But if the company employs its own sales force, the contribution margins will be up to $7.6 million. Total fixed expense will be $7,125,000. The break-even sales will be $15,000. Next, please. After compare the break-even sales, my suggestion is increasing the ability to adapt to market change, increasing the ability to resist raise to the market. Next, please.
So for the problem 2, let's compare of the net income. According to the income statement on the right side, we can find out that the income before tax under 15% commission is 1.6 million. In order to reach the same net income under 20% commission rate, we can set the sales revenue as X. So the commission will be 0.2x, and the contribution margin is sales minus variable expense, which equal X minus 7.2 million minus 0.2x. The net income before tax will be the contribution margin minus fixed expense, which equal X minus 7.2 million minus 0.2x and minus 4.8 million. So let two equations equal, we can get X is 17 million. Next slide, please. So if we want to get the same net income as continued in the budgeted income statement for the next year through agent and pay them 10% commission rates, The sales revenue need to reach 17 million. So we will give the suggestion as below. With the rise of the new retail model in the recent year, the direct sales model used by Amway is generally losing their advantage. So Amway should build their own sales force. Next, please.
After comparing the old and new commission rates income statement, let's turn our focus on the plan of building an Amway sales force. Here's the comparative income statement between hiring sales agents at 20% commission rate and having an Amway owned sales force. Our goal is to find out at what point of our sales ad the income generating from the two plans would be equal. So our first step is to set the sales of each plan to be X. Then the commission expense under the rates of 20% is 0.2 times X. Then its contribution margin would be sales minus manufacturing and commission cost, which equals to X minus 7.2 million minus 0.2 times X. From previous part, we know that the fixed expense is 4.8 million, so we can write the net income under 20% commission rates as a function of X, which equals to the contribution margin minus fixed expense. So let's name this equation 1. We will use the same method to write the income of building an Amway owned sales force as another function of X, which equals to X minus 7.2 million minus 0.075 times X minus 7.125 million. And we will name this function equation 2. Let's apply algebra here to make equation 1 equals to equation 2 to solve for X. The result we get is 18.6 million, which means that if we are expected to have a sales of 18.6 million in next year, we will generate the same income no matter we hire sales agent at the 20% commission rates or building our own sales force. However, if the company is confident that they are able to make more than that, it would be better for Amway to build their own sales force to gain higher income. According to a sales report from Amway, they claim that they have a sales of 8.5 billion in 2020, and they are expecting to have a higher sales number in the following years because people are paying more attention to their health after experiencing the COVID pandemic. So, based on these comparative income statements, I would suggest Amway to build their own sales force.
Operating leverage, which equals to contribution margin divided by net operating income. The contribution margin equals to sales minus variable costs, and net operating income equals to contribution margin minus fixed operating costs. From the budgeted income statement, we can see the variable costs include variable manufacturing expenses and commissions in agents. The fixed costs include the fixed overhead manufacturing expenses, fixed marketing expenses, fixed administrative expenses, and fixed interest expenses. So when the agent's commission rate remains 50%, the contribution margin equals to $6,400,000, and net operating income equals to $1,600,000. So the operating leverage equals to 4. When the agent's commission rate increased to 20%, the commissions to agent will increase to $3,200,000, and the other costs remain the same. The contribution margin equals to $5,600,000, and the net operating income equals to $800,000. So the operating leverage equals to 7. If the company employs its own sales force, the company will cut the commissions to agents, will increase its fixed expenses, $2,400,000, including $1,200,000 commissions to its own salespeople, and at the same time, decrease the fixed administrative expenses to $1,725,000, and the contribution margin equals to $7,600,000, and the net operating income equals to $475,000. So the operating leverage is 16. In conclusion, in the first situation, when the agent's commission rate is 15%, the operating leverage of Amway company is 4. when the agent's commission rate is 20%, the operating leverage of M1 company is 7. If the company employs its own sales force, the operating leverage of M1 company is 16. So my suggestion is, the first one is the M1 company should continue to hire outside agents, since employ their own sales will increase the fixed costs, thus increase the operating leverage and its operation risks. And the second one is to make comparisons to the companies in the same industry about the operating leverage before make the decision.
So in conclusion, since Amway is multi-level marketing company, it uses a kind of an award system that requires appropriate amount uh, of commission rate to make both the company and the salesperson profitable. And through our calculation, under the expected sales, we should build the sales force since the perspective of the long-term profit. And because of the direct sales mode has lost its advantage compared to the past. And building the own sales team is easier for the company to manage and control the commission rate. So having the sales force will help the company to earn more. Also, Amway is not profitable in recent years. We can think about uh, how the direct sales model can adapt to the current time. For example, since it's COVID time, the salesperson can hold the Zoom meeting about beauty products to interact with the customers and to sell the products to make the company profitable. And generally speaking, just like any companies in the world, Amway should just change the business strategy as the time changes.